Investors continue to wrestle with whether the globe's mountainous debts or ultra-loose central bank monetary policy will win out in the end. Now, if the debts squash growth and the world emulates Japan's experiences of the last 20 years, then we could well get deflation. The cost of living falls. If central bank interest rate cuts and quantitative easing, or QE, win the day, then we'll get inflation, sharp rises in the cost of living. We could end up with a third path and a return to the 1970s with stagflation, rising prices, no growth, and in fact the worst of all worlds. Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Breaking the Mould, our regular look at the financial markets. This week, we're going to be analysing these three possible scenarios and what asset prices are telling us might be the most likely outcome. Now, markets are not efficient. Don't let anybody kid you otherwise. It'd be impossible to make a profit if every security was always perfectly priced. However, markets are smart and their views must be respected. Even if you disagree, you should listen to what the market's telling you as a stress test against your own research and views. Now, right now, market action to my eyes looks deflationary. Just check out the charts that are coming up. Government bond yields continue to go lower. This graphic shows US, UK and German 10-year bonds. Secondly, commodity prices are going nowhere faster down, even allowing for January's oil price bounce. The next chart shows the Bloomberg Commodities Index, which tracks the price of 22 raw materials, fuels and foodstuffs. It languishes at a 5-year low. Global stock markets are also particularly telling. This third graphic looks at the S&P 1200 index by sector over the past year. Note how the best performing sectors are healthcare, tech, consumer staples and utilities. All sectors where there's at least some degree of pricing power, which, possible exception of tech, results from an element of guaranteed demand. We all get ill, we all need to eat, we all need to keep warm and get washed. Now, the laggards are energy, raw materials, where commodity price weakness is taking its toll, and also financials, where the regulatory pressure and disintermediation of established banks by crowdfunders, peer-to-peer lenders and newcomer banks may be taking their toll. Now, this is all global, not just the UK, and if, and it's still an if, markets are right and deflation is coming, then anything which generates a safe, reliable, positive yield could become highly prized. That's the lesson from Japan, as it's wrestled with deflation since the early 1990s. That means bonds and equities where the company has the pricing power and thus strong cash flow needed to pay the coupons and dividends. It also means cash actually could look quite good, especially if bond yields go lower and interest rates remain stuck at zero, because falling prices would increase the value of the cash in real terms. Now, markets could be wrong, it's happened before, and central banks are determined to stop the world turning Japanese with the QE schemes and interest rate cuts designed to fuel inflation. Inflation, so long as it's not of the rampant double-digit percentage variety of the late 1970s and early 80s, tends to favour equities over bonds if history's any guide, especially as rising prices erode the value of the fixed predetermined bond coupons. Gold, commodities and property have done well during past mildly inflationary episodes, mid-80s to the turn of the century, for example. Now, the third scenario, stagflation, is thankfully very rare, and the mid-70s gives us our only real little sample here. It was an awful time for bonds and most stocks. Only gold really emerged unscathed, along with select equity sectors, consumer staples, and anything could stick down your throat or the sink. Now, we all need to keep watching the signs from the markets, and if GDP growth suddenly takes off, wage prices start, the situation could change again. Although it is possible to design a well-balanced portfolio to offer some upside and also a degree of downside protection in the event of any of the three scenarios, with careful asset allocation, selection of the right individual stocks, bonds or funds. Thank you for your time, and see you next week.